When individuals lose confidence in fiat currencies, they may turn to precious metals despite their fears. Inflation has been a significant driving force for concern among people, and it is likely to define the investment landscape for the next decade. Thus, it is reasonable to assume that precious metals will perform well during periods of inflation. Central banks appear to be stuck in this situation. In the 1970s, we experienced high levels of debt that are comparable to the current situation we are facing. Despite a decade of rising inflation during that time, it may surprise you that the debt-to-GDP ratio actually decreased by the time we reached 1980. Back then, the debt-to-GDP ratio was at 30%, whereas now we are at 130%. To understand how we can tackle the current inflation, we can look at what ended the inflation in the 1970s. The then Fed chair, Volcker, was able to raise rates and had the courage and ability to do so, which is an important aspect to consider. He managed to raise rates to 20% for a brief period, which may seem crazy to some people today. I understand that his ability to handle the debt was due to the low debt-to-GDP ratio at that time. In contrast, today's debt relative to economic output is over 4 times higher than it was in the 1970s. Therefore, in my opinion, central banks will likely take a tough stance and raise interest rates to some extent, but they may not be able to increase them significantly. If they do, it could lead to a recession, and they will have to lower the rates again. They are aware that increasing rates too much could make it difficult to pay the interest on the huge debts we currently have. All types of debt, government, consumer, car loans, student loans, and mortgages are at record levels. The Federal Reserve is aware of this and faces a dilemma: how much can it increase interest rates without causing widespread harm? The government may even resort to printing money just to pay the interest on its debt. As a result, the central bank's options are limited. While they may try to sound tough and suggest raising rates to control the situation, they cannot do so without causing significant damage. In fact, it may be in their interest to allow inflation to increase, as it can make it easier to pay off debts over time due to the declining value of money. In practical terms, there may not be much that the Fed can realistically do, and they may not openly acknowledge this fact. Their strategy may be to talk tough and manage expectations. However, the reality is that they can only raise rates to a certain extent without causing significant damage to the economy. As an example, gold and silver prices have increased significantly since 2000, with gold reaching $2,000 twice and silver hitting $50 twice. Therefore, it is important to consider the limitations of the Fed's actions in the face of economic challenges. The catalyst for a surge in precious metal prices will occur when the Federal Reserve stops raising interest rates due to the realization that inflation is uncontrollable and a recession is imminent. This action will cause rates to decrease and possibly be cut, signaling a significant increase in the demand for precious metals. The demand for silver, in particular, is often tied to sentiment as it is seen as a safe haven asset during times of fear. The investment demand for silver is undervalued in terms of its potential impact on the market. While silver is also a widely used industrial metal, its volatility makes it a popular choice for investors seeking to hedge against economic uncertainty. This implies that silver is used in electronics, electrical applications, EVs, and various medical uses. Its primary use is in solar energy. Despite the possibility of a slowdown, the shift towards a green economy and green energy, particularly solar energy, has significant support. In some countries, solar energy is the most cost-effective way to add power to the electrical grid. Additionally, solar energy continues to become more affordable. Silver accounts for 11% of the annual supply used in solar energy. Given the extensive support for the transition to green energy, there is likely to be a price floor for silver. It makes sense to have a higher cost for physical silver, particularly for a single ounce, than the spot price. However, the spot price must rise, and I am confident it will as people lose faith in fiat currencies and turn to precious metals. When this happens, demand for physical silver will surge, causing overwhelming shortages and sky-high premiums. It's already difficult to obtain inventory now, and I expect the situation to become even more volatile. That's why I recommend people to buy at least a small amount of physical silver, as it has proven itself as a safe haven asset for hundreds and thousands of years, and I believe we're heading back towards that direction. Gold and silver are regarded as the anti-dollar, implying that there's a shift happening towards a future where precious metals will potentially back currency once again. Whether or not this backing is overt, there could be a significant announcement from a prominent institution like the Bank of China. For instance, the bank might disclose an increase in the amount of gold they hold from 1,500 tons to 5,000 tons or even more, which would place them on equal footing with the officially stated U.S. gold reserves of around 8,000 tons. This suggests that we are witnessing an evolution towards a monetary system that values precious metals. Their economy may take a couple of years to match the size of the U.S. economy, so they are playing the long game. An overnight announcement could be a significant game changer, so people should not be complacent about it. It's important to be cautious of recency bias and not assume that recent experiences will continue into the future. Therefore, it's essential to explore non-mainstream sources of information, evaluate arguments, and make logical conclusions. While history doesn't necessarily repeat, it often provides valuable insights. For example, looking at what happened in the 70s could be a good indication of where we are headed. It's crucial to prepare for what may be coming, so people should be proactive in their approach. When analyzing the situation, it becomes apparent that the sudden increase in silver prices during the silver squeeze was not a viable long-term trend. Although silver rose from 25 to 29 within a few days, it was not due to a fundamental shift in demand, and it wasn't sustained for long. As expected, the surge in silver stocks eventually died down, and the only notable change was the already high premiums on silver that had skyrocketed even further since the pandemic began. This is a fascinating development worth noting. There were instances where the spot price of silver surged to as much as 75 or even 100. The noteworthy aspect is that silver bullion dealers reported being completely inundated with demand, which was unusual even for those with decades of experience in the field. As a result, some had to close their phone lines and websites due to the overwhelming traffic and crashing issues. Furthermore, they had no inventory left to sell to potential buyers, despite the fact that most of the orders were relatively small. The retail sector was a major contributor to the surge in demand, with customers seeking a few ounces of silver immediately. This led to delivery times increasing from 2 to 3 days to 2 to 3 weeks. It will take a significant amount of demand to overwhelm the paper market, but it is likely that the spot price will need to rise. However, the physical price will always be higher than the spot price because a higher price for physical silver can be justified. Producing a silver coin requires a significant amount of effort relative to its current value. This is because of various processes such as manufacturing, distribution, warehousing, and profits. Therefore, the premiums on silver coins are relatively higher than those on gold coins, which require less effort and have smaller premiums on a percentage basis.